Hello and welcome again to my channel. For those who are new, I am Gletz Marby Kasama, your Filipino accounting teacher. Before you watch this video lecture, please watch the previous video so that your learning can be maximized. The link is on the description below. So for those who have already watched it, let's continue with this video. This video aims to let you fully understand the identification of transactions as well as analysis of transactions, which is the step 1 in the accounting cycle. This lecture contains the following: the concept of identification of transactions, and we are also going to discuss about the significance of the accounting equation A is equal to L plus E. We are also going to enumerate the types of transactions that you might encounter as well as their effects on the assets, liabilities, plus equity. So we are also going to talk about the concepts of accrual, revenue expenditure versus capital expenditure, and depreciation. And lastly, we're gonna have some illustrative problem related to transaction analysis and of course with solution. So now let's start with the identification of transactions as well as the equation A is equal to L plus E. As I have told you in the past, not all the business transactions are accountable. Accountable transactions are those that can be measured in monetary amounts, that's the first characteristic, and those that can affect the A is equal to L plus C amounts. This is the second characteristic. That is why transactions like mere hiring of employees and signing of contracts with suppliers or clients are considered unaccountable. So let's go to A is equal to L plus C and let's go back to the simple definitions of assets, liabilities, and equity. Assets are resources controlled by the entity. The entity do not need to own such assets as long as their benefits are controlled by the entity. To make it clear, let us have examples. We have cash, machinery, land, supplies, and many others. While liabilities are the amounts owed by the entity to the third parties, like for example, loans from a bank or if the entity purchased something on credit or on account. And if liabilities are owed to third parties, the equity is the amounts owed by the entity to its parents or owners. The equity is composed of, let's start with the increases. It will increase if there are investment from owners. It will also increase if there are revenues earned from customers. How about decreases? It will decrease if there are withdrawals by the owners for personal use and expenses for doing business. Sir, some says that equity is a residual account. What does it mean? Well, in case the business stops its operations, assets are distributed first to third-party creditors and the balance will go to the owners or the investors. So, simply stated, assets minus liability, we have the equity. So that's why it's called the residual amount. Sir, you said that equity is somewhat like the liability of the entity to its owners. We understand that the entity is really liable for the owner's investments, less of course their personal withdrawals. But why are the revenues and expenses included in the equity amount? Since the owners are the ones who started the business and assumed all the risk, then all the benefits like revenues from customers less business expenses must be given to them. However, if the business expenses exceed revenues, then they are the ones who will also suffer. Sir, but what is really the meaning of A is equal to L plus E? Why is this equation very important? Guys, since the businesses have no physical body like us, think of that equation as the business itself. Sir, we do not agree because we can see and touch business establishments. Actually guys, those are just the assets of the entities, like buildings owned by the entities. Let's say for example, if you own a house, that doesn't mean you are your house, right? So if that is clear, the next is, think that the accountable transactions changes the business. These accountable transactions are like people's experiences that changes us. So how about unaccountable transactions? This can be compared to our small unimportant experiences that don't even matter. I hope that's clear. Please take note that on the next topics, I would like you to assume the shoes of the entity or think as if you are the business entity. Because as an accountant, you need to analyze business transactions as if it is happening to you. So we are now on the topic 3, 4, and 5. Topic 3 is all about the types of transactions and its effect to A is equal to L plus E. But remember, you need to assume as if you are the business and the transactions are happening to you. The number 4 topic is all about the accrual concept, and we are going also to discuss the topic 5, which is capital expenditure versus revenue expenditure. So let's go now to the types of the transactions and how it will affect the assets, liabilities, and the capital. But before we do that, here are some important notes. The first one is, each transaction has at least 2 effects on the A is equal to L plus E. That means, if one asset increases or decreases, there should be at least another asset or liability or equity account that will also be affected. And number 2, whatever transactions are considered, the equation A is equals to L plus E will always be true. So okay, let's start with the transactions already mentioned in the previous slide. Let's start with the investment from the owners. If we have this transaction, I've said earlier that this type of transaction will increase the equity account. But not only the equity or the capital account is increased, but also the assets of our entity. That is the meaning of this note. Each transaction has at least 2 effects in the A is equal to L plus E. Another is we have revenues from customers. If we receive revenues, not only the capital account will increase, but our assets will also be added. Example is, we increase our cash if the customers avail for our services or our products. But take note of this. Even if the customers do not pay yet, so long as the services or products have already been delivered, we still increase our capital because of revenues, and we increase the assets not by way of cash but by receivables. Why is it so? It is because we follow the accrual concept, and the accrual concept states that revenues are recognized when earned. So that happens when goods and services are already given to the customer and not when collected. In simple terms, unpaid services or products delivered to the customers are still recorded as revenues and at the same time as receivables. Technically, these revenues earned but uncollected are known as the accrued revenues. Another important twist is that you cannot expect that 100% of your receivables can be collected. There might be portions of it that are considered doubtful. So, if we have this doubtful, you need to deduct it with the capital account because they are considered as bad debt expense. Let's say, for example, you have a total of 100,000 worth of receivables and you suspect that 10% of it will be uncollectible. So you should deduct 10,000, which is the 10% of your receivables. And you should also deduct your assets as allowance for doubtful accounts. What is this allowance for doubtful accounts? This is a contra-receivable account, which means that if you have this, you should deduct it from your receivables to get what do we call the net realizable value of your receivables. Next is we have withdrawal by owners. If owners withdraw money for personal reasons, then the capital will be deducted by such amount and of course the total assets. We also have expenses. But before we go to the effect on the assets, liabilities, capital, or equity, let me clarify something. The expenses that we are talking about are considered as revenue expenditures. What are these? These are expenses for items whose benefits are already consumed by the entity. For example is, when you pay for water bill issued by water districts or suppliers for the water you have already consumed this month. So how do we differentiate it from the capital expenditures? Capital expenditures are expenses for items whose benefits are yet to be consumed by the entity in the future. Example is when you pay for, let's say, machinery, where you are still to enjoy its benefits or usage in the future. So let's go back to expenses. When we have expenses, our equity or capital account will decrease, and also is our assets. That is, if we paid for it in cash immediately. But remember this, Even if we haven't paid yet for the services or the benefits of the items we already consumed, expenses will still be recognized. That's why the capital will be decreased. However, instead of deducting the assets just like we did here, we are going to add the liabilities because it has become our debt payable in the future from the moment we enjoy the benefits of the services or the products. Why is it so? It is because of the accrual concept again, which additionally states that expenses are recognized when incurred or when the products or the services are already consumed by our entity and not when paid. By the way, these unpaid expenses for services or products are technically known as accrued expenses. Next is we have advance collections from customers. So if we have this, then logically of course, our assets will increase, specifically the cash. But we are not still going to increase the equity account because they are not yet considered as revenues, because we have not yet delivered services or products to the customers. Let's go back to the accrual concept. It said that revenues are recognized or recorded when earned and not when collected. So sir, if we do not increase the equity or the revenues, what account will be increased, sir? The answer is the liabilities. You are already liable or obligated to deliver goods or services from the moment you accepted the advance payment. And by the way, these advance collections are technically known as deferred revenues, the opposite of accrued revenues. Diba? In the past, I said in the accrued revenues, the customers are late in paying. But in deferred revenues, it's not the case. The customer pays in advance. But in the moment that you have already earned those payments, you're just going to deduct the liabilities and you are going to add the capital account because these are already considered as revenues. We also have our own advance payments to others. Let's say for example, advance payment for rent or prepaid insurance and etc. When we pay in advance, then logically, we lose an asset. And that asset is specifically the cash. But we do not treat the payment as expenses yet because we did not consume any benefit yet. So instead, we increase another type of asset known as the prepayments or deferred expense. If you translate deferred expenses, then in simple terms, we can call this not yet expenses. It is the perfect opposite of accrued expenses. If accrued expenses are expenses incurred but not yet paid, deferred expenses are not yet incurred but it is already paid in advance. If you analyze deeper, it's as if there is no effect in the total assets balance because although one asset is sacrificed, which is the cash, another was increased in the form of deferred expenses. I hope that's clear. But the moment you have consumed the benefit already, then you are going to deduct your assets and you are also going to deduct the capital account because the advance payments are already considered as expenses already. We can also incur debt like loans from a bank or when you are going to purchase something but you are to pay later pa. Upon incurring such debt, the liabilities will be increased. But of course, the assets will also increase. And if those loans or liabilities are paid back, then the effects are opposite. The liabilities will decrease, and so is the assets. The only twist here is if there are interest expenses. So interest expenses are considered as any other expenses. So if there are interest expense, the capital will be decreased, and of course the assets will be decreased also if it is paid immediately. However, if those expenses are not yet paid immediately, then you're going to recognize expenses. So you're going to deduct the capital account, but you're going to recognize liabilities because now you have an interest payable already. We can also exchange an asset with another asset. So of course, the assets will increase, but there is also another type of asset that will decrease. So if you're going to analyze this as if there is no effect on the total assets. So an example of which is the cash purchase of machinery where you sacrifice the cash, however you are going to acquire another type of asset which is the machinery. The only twist here is when you pay partial. For example, this illustration, where office equipment was purchased at 100,000, however, the down payment given is only 30,000. The rest is payable in 10 days. Of course, the assets will increase by 100,000 in form of office equipment. However, the asset will also decrease because of the down payment of 30,000. So in effect, or in summary, the assets increase by only 70,000 and the liabilities will increase by 70,000 because again, out of 100,000, 30,000 was only paid. The last transaction that we're going to talk about is the depreciation. However, before I talk about the concept of this one, let me tell you first that depreciation is an expense. So if this is an expense, you're going to deduct the capital account because expense transactions are a decrease on the capital account. And of course, you are going to decrease the assets. But I know you need to know about depreciation. So let's go to depreciation. The depreciation is related to depreciable assets. What are these depreciable assets? These are long-term assets, or simply stated, these are assets whose useful lives are more than 1 year, or they can be used for more than 1 year. Not only that, these long-term assets must also be affected by physical wear and tear due to passage of time or continuous usage. So, long-term assets like land are not subject to depreciation. So what is depreciation? It is a deduction of the value of the depreciable assets per period due to physical wear and tear. And how can it be computed? Let's have an illustration to do just that. So equipment has a value of 100,000 that has a useful life of 5 years and a salvage value of 5,000. So no need to explain about the useful life because it is self-explanatory. But we need to talk about the salvage value, or what do we call the scrap value sometimes. The scrap value is the amount that can be realized if the item is sold to, for example, junk shops after the asset has been fully utilized. To compute for the depreciation expense, step 1 is to get the depreciable amount. So we have the historical cost of 100,000, but since the problem provided for a salvage value, then you deduct that 5,000 and then you are going to have the depreciable amount of 95,000. Sir, what is this depreciable amount? The depreciable amount is the total decline in the value if the asset becomes useless. So if you analyze the problem, then the conclusion is even after the equipment has been fully utilized, it still has a value of 5,000. So the maximum decrease in its value during its useful life of 5 years is only 95,000. The next step is to divide the depreciable amount with the useful life, which is 95,000 divided by 5 years equals 19,000. So that is the depreciation, or what do we call decrease in value per year of the equipment because of physical wear and tear. To understand it further, let's have a timeline analysis of value and depreciation charged per year on the asset. So as you can see, you start with 100,000 and then minus 19,000, you have 81,000, and then another 19,000 is deducted, so we have 62,000, and at the end of year 3 another 19,000 was deducted, so we have 43,000. Another 19 will still be deducted at the end of year 4, so we have 24,000, and lastly the last 19,000 is deducted, so we have still 5,000 value of the equipment even after the useful life of 5 years. So that's it for depreciation. But let me remind you again, if you wanted to get the depreciation expense under straight line method of depreciation, then you need to deduct the salvage value with the cost before dividing it with the useful life. And now, let's go back to the previous slide. So, we are back on this slide in order to tell you one thing, and that is, these transactions related to these arrows with orange colors are to be recognized usually at year end. For example, these doubtful accounts are to be estimated usually at the end of the year. Of course, if there are revenues that are already earned but the customers did not pay yet, or accrued revenues, those are to be traced at the end of the year, as well as your accrued expenses. And if you have earned a portion of the advance collections from the customers, those are to be recorded at the end of the year. And in case of your advance payments, of course, the portion consumed are recognized at the end of the year also, as well as the depreciation. So here we are in the last portion of our video lecture. So let's go to the comprehensive illustration. On November 1, 20x2, GAAP or Gletsmer Accounting and Auditing Practice has the following transactions during the months of November and December. Here are the transactions for the past 2 months. So in here, we have transactions A to J and adjusting transactions on 1 to 6. So our job is to know their effects on the accounting equation assets equals liabilities plus capital. In transaction A, the owner invested 100,000 in the business. So of course, the capital account will increase as well as the assets involved. So we have a balance A is equal to L plus C. However, this transaction B, where the business paid for business permits and licenses of 2,300, it's a typical example of revenue expenditure, and this type of expenses decreases the capital and of course the assets because we have already paid for these business permits and licenses. While on letter C, the rent for 5 months, which is 3,000 per month, so all in all, we have to consider 15,000, was paid in advance at the beginning of November. This is a deferred expense because it is an advance payment where we did not consume the benefit yet. So here, the cash will be decreased by 15,000. However, the deferred expense or prepayments, or in this case, it is better to call it prepaid rent, is also increased by 15,000. Remember, deferred expenses are also considered as assets, so they offset each other. That is why, in this transaction, there will be no effect on the total assets. In letter D, supplies were purchased for 20,000. However, 10,000 was paid in cash and the rest were paid after 2 months. In here, although the assets in the form of supplies increased by 20,000, another type of asset was sacrificed, which is cash of 10,000. So in effect, the net effect on the total assets is only an increase of 10,000. And of course, 10,000 liabilities will emerge because of the transaction. In letter E, office equipment was purchased for 30,000. There is no effect in the total assets because even if we have received a new equipment, we lost cash also. So there is no effect. We are in effect just exchanging an asset with another asset. So letter F is another type of expense. So we just need to deduct the capital as well as the assets also. As well as letter G is also type of an expense, utilities for water, electricity, and etc. So we're just still going to deduct the capital 19,750 and the assets also of 19,750. In letter H, 3 clients paid professional fees for 5 months in advance at the beginning of December 20x2 or the second month in our illustration, worth 80,000. This advance payment is considered as deferred revenue, right? Where we receive cash first before we do some service or deliver products. So what do we do with this? Of course, we're going to increase the assets of 80,000, but we are also going to increase our liability account. We have 80,000 also. Now, we are not required to pay cash in the future to settle this liability, but we must provide in the future some goods or services to these clients. On letter I, other clients paid 40,000 for services already rendered. So logically, we just need to add 40,000 to our total assets and also add the same with the capital because they're already considered as revenues because services are already rendered. And lastly, letter J, the owner withdrew cash 25,000 for personal purposes. So withdrawals, according to our discussion a while ago, by the owners are deducted from the capital account. And that you also deduct the total assets on the amount of the withdrawal. So let's go now to the transactions for adjustment. Transaction number 1 is directly related to transaction C above. It states that the advance payments for 2 months was already used. So since the monthly rent on letter C is 3,000 per month, then you multiply it by 2 months, then we have 6,000. So you need to deduct your assets with 6,000, specifically the prepaid rent account, and then you're gonna deduct also the capital because they are already considered as expenses. While transaction number 2 is related to transaction D above. The supplies purchased was worth 20,000 according to here. However, in the transaction number 2, only 3,500 worth of supplies remained. So, we can conclude that the difference of 16,500 was already consumed. So, you need to decrease the supplies account, which is an asset account worth 16,500, and of course, there is also a decrease on the capital account because of the supplies expense. Transaction number 3 is an additional information about transaction letter E. It says that the 30,000 equipment has a salvage value of 500 and a useful life of 5 years. So in here, we need to compute the depreciation expense by first computing the depreciable amount. So we have 30,000, the historical cost, and the salvage value of 500. So we have a depreciable amount or depreciable value of 29,500, and then you divide it by the number of years of useful life. So we will have a depreciation per year of 5,900. But remember, we're only talking about 2 months, November and December. So you need to multiply this one with a fraction, which is 2 months over 12 months, and you will have 983.33. And since depreciation is a type of expense, the capital account will be decreased, and also the assets will also be decreased. Transaction number 4 is an unpaid expense or accrued expense. Such expense, if you can still remember, shall still be recognized. Therefore, you should deduct the amount 3,000 from the capital. And of course, since it is still unpaid, you recognize it also as a liability. Transaction number 5 is an accrued revenue, where the entity has already delivered products or services, but the customer is late on its payment. It will still be recognized as revenue, so you add the capital account with 5,000, and of course the assets, 5,000, but not in the form of cash. It is in the form of receivables. Transaction number 6 is directly related to transaction H, where there is an advance payment from customers worth 80,000. It has been recognized earlier as a liability. Now, transaction 6 states that 1 month out of 5 months have already been earned. So we have 80,000 divided by 5, or you multiply it times 1 over 5, then you're gonna get 16,000. So what will happen? So your liabilities will be decreased because you have already earned the 16,000, and of course, you're going to recognize the 16,000 as revenues already. So that's it for our analysis. The next step is to add all the effects of the transaction in the assets, liabilities, and equity. And you're gonna get in the assets 134,466.67. On the liabilities, you will have 77,000 and 57,466.67 for equity. If you add the liabilities and equity, the sum is really equal to assets, which is 134,466.67. This is what do we call balanced. So to end this, please always remember that each accountable transaction has at least 2 effects on the A is equal to L plus E or L plus C. And whatever the transactions are considered, the A should always be equal to liabilities plus equity or capital. So that's the end of our video. If it helped, please click like and subscribe and share this to other students. Also, please click the notification bell to be updated on my latest videos. This is again Gletzmar B. Kasama, the Fact, the Filipino accounting teacher.